Captive and other risk financing options. Traditionally, businesses and other organizations have handled risk by transferring it to an insurance company through the purchase of an insurance policy or alternative by retaining the risk and allocating funds to meet expected losses through an arrangement known as self-insurance, in which firms retain rather than transfer risk. During the liability crisis of the 1980s, when businesses had trouble obtaining some type of commercial insurance coverage, new machines for transferring risk developing facilitated by passing of the Product Liability Risk Retention Act of 1981. These so-called alternative risk transfer (ART) arrangements blend risk transfer and risk retention mechanisms and together will self-insurance from the alternative market. Captives, a special type of insurance company set up by a partner, parent, parent company, trade association, or group of companies to insure the risk of its owner or owners, and risk retention groups in which entities in a common industry join together to appear. Other options including risk retention pools and large deductible planning, a form of self-insurance, followed ART products such as catastrophe bonds. Whenever detectives and microshorts programs are also emerging as an alternative to traditional insurance and reinsurance products. Alternative market mechanisms. Captives. Voluntary owners captives are companies set up by large corporations to finance or administer their risk financing needs. If such a captive insures only the risk of if parents or subsidiaries, it is called a pure captive. Captives may be established to provide insurance to more than one entity. An association or group of companies may band together to form a captive to provide insurance coverage. Professionals, doctors, lawyers, accountants have formed many captives over the years. Captives may in turn use a variety of the reinsurance mechanism to provide the coverage. In particular, many offshore captives use a fronting insurer to provide the basic insurance policy. Fronting typically means that underwriting, claims, and administrative functions are handled in the United States by an experienced commercial insurance company, since a captive generally will not want to get involved directly in running the insurance operation. Also, fronting allows the company to show it has an insurance